Welcome to This Explainer. If you've been to the gas station lately, you know exactly what we're talking about today. Prices are just climbing, right? Oil has officially crossed that scary $100 a barrel mark, and let me tell you, Wall Street is sweating. So today, we're going to break down exactly why this is happening, what it means for the broader economy, and most importantly, how you can actually prep your wallet for what might be coming our way. Let's get into it. Okay, I want to kick things off with a pretty shocking statistic. 10 out of 12. Historically speaking, almost every single time oil prices spike the way they are right now, America ends up in a recession. Not just a couple of times, 10 out of the last 12 times. It's wild, right? So the massive question hanging over everyone right now is, are we heading into another one? Let's unpack the data. First up, the oil price explosion. We really need to look at why $100 a barrel matters so much today. A huge piece of this puzzle actually comes down to geography, specifically one critical choke point. Growing tensions in the Middle East are directly threatening the Strait of Hormuz. Now, why does that matter? Because roughly 20%, a fifth of the entire world's daily oil supply, has to pass right through this one narrow waterway. When there's even a hint of conflict threatening that supply, well, the market panics and prices shoot up fast. And here's the thing, when oil prices go up, the pain doesn't stop at the gas pump. It sets off this massive ripple effect. Right now, Brent crude is trading above $107 a barrel, and U.S. oil is over 102. These are some of the absolute highest levels we've seen in years. So what happens? Sure, gasoline surges, but suddenly your groceries are more expensive because it costs more to truck them to the store. Flight prices go up, shipping costs jump. Even those late-night online deliveries you rely on, they cost more to get to your door. It's basically an invisible tax on literally everything you buy. Which brings us to the scary historical pattern and what past oil spikes actually tell us. History paints a really stark picture for us here. Major oil price spikes are almost always followed by recessions. Look at the timeline. The 1973 oil crisis, recession. The 79 Iran crisis, recession. The 1990 Gulf War, recession. Then you've got the 2008 oil spike leading right into the Great Recession, and of course the 2020 pandemic disruptions. So that 10 out of 12 statistic we talked about earlier, it's not just some random coincidence. It is a glaring historical warning sign. Now, does this absolutely guarantee a recession this time around? No, of course not. But it is one massive, flashing red light on the economy's dashboard. So, how oil triggers recessions? Let's look at the domino effect of crude. Before we get too far, let's just clearly define what a recession actually is, because that word gets thrown around a lot. Officially, a recession happens when the economy shrinks for 2 consecutive quarters, so about 6 straight months. In plain English, it means companies make less money, consumer spending drops, the stock market usually takes a hit, and layoffs start going up. Ultimately, it just means life gets harder. Good jobs become scarce, your savings take a hit, and everyday businesses really struggle to keep their doors open. And because oil basically powers our entire modern world, expensive crude sets off a really dangerous chain reaction. It's like a giant line of dominoes. Step 1, oil and gas prices rise. Step 2, that makes shipping and manufacturing costs jump up. Step 3, companies obviously can't absorb those extra costs forever, right? So they hike prices on everyday goods. Step 4, because everything costs more, everyday folks like you and me are forced to just spend less money. And finally, step 5, since consumers aren't buying, businesses aren't profiting, inevitably the layoffs begin and the whole economy just grinds to a halt. That right there is the exact anatomy of an oil-driven recession. Plus, remember, inflation is already pretty high right now, which makes this whole chain reaction even more dangerous. All of this leads directly into the Federal Reserve's dilemma, where they are totally caught between fighting inflation and a slowing economy. You see, the Fed controls interest rates. And right now, they're facing an almost impossible balancing act. On the one hand, they absolutely have to fight high inflation, and they do that by raising interest rates to cool things down. But on the other hand, doing that risks severely damaging an already fragile economy. Basically, if they slam on the brakes too hard, they actually cause the exact recession they're trying so hard to avoid. Talk about being stuck between a rock and a hard place. And just to highlight how urgent this is getting, financial market traders recently bumped up the probability of another Fed interest rate hike to nearly 45%. To really put that into perspective for you, just 1 month ago, that number was sitting at like 1%. 1% to 45. That is a massive, incredibly sudden shift, and it really shows just how much fear is brewing in the markets right now. But we have to remember how this actually impacts you directly. When the Fed raises rates, borrowing money across the board gets so much more expensive. Your credit card payments, they go up. Trying to get a loan for a new car, gonna cost you more. Mortgage payments rise, which makes buying a house way less affordable. And naturally, when borrowing gets this pricey, people just close their wallets and spend less money, which, if you remember our chain reaction from earlier, slows down our consumer-driven economy even further. Unsurprisingly, the stock market is already reacting to this toxic combo of rising oil and rising bond yields. After a pretty solid rally earlier this year, stocks are starting to pull back. Tech stocks in particular are taking a really hard hit. You might be wondering, why tech? Well, it's because technology companies rely super heavily on future growth and borrowing money, so investors get incredibly nervous when interest rates creep up. Historically speaking, this dual pressure of expensive oil and expensive borrowing puts a really heavy ceiling on the overall market. Okay, enough of the gloom. Let's pivot to how to protect yourself and look at some actionable steps to defend your wallet right now. Instead of panicking over all this macroeconomic stuff that we really can't control, let's focus on what we can do. To build up your financial shield, you really want to start by prioritizing your cash. Aim for a 3 to 6 month emergency fund. Even if you have to start small, just start. While you're building that up, get super aggressive about paying down high interest debt. As those rates rise, credit card balances are only going to get more toxic. When it comes to your portfolio, whatever you do, don't panic sell. You might also want to look into some defensive investments like energy or gold, though definitely do your own research there. And finally, just trim the fat. Cancel those subscriptions you never use and keep your cash close while things are so uncertain. I really want to pause here and emphasize that point about not panic selling. It is absolutely crucial to just stay calm and objective. Yes, I know the historical pattern of these oil-driven recessions is intimidating, and logging in to see red in your portfolio is never fun. But history actually gives us a lot of comfort here. It shows us time and time again that long-term investors who just stay patient, who ride out the storm instead of selling at the absolute bottom, they almost always recover and outlast the panic sellers. Just stick to your long-term plan. You've got this. So, with oil holding above $100 a barrel, high inflation stubbornly sticking around, the Fed weighing more rate hikes, and all these historical warning signs flashing brightly on our dashboards, what happens next? Look, nobody knows for absolute sure what tomorrow holds, but the warning signs are undeniably real. The good news, though, people who plan ahead handle these economic downturns way better than people who just ignore the data. So here is the crucial question I want you to consider today. Based on all the data we've walked through in this explainer, do you think a recession is coming? Let me know what you think and keep using these insights to protect your financial future.